$1,000 is a lot of money. But when it comes to investing, if you pick your cards right, you can make it work a pretty good amount. Hey guys, just Vaish here. If you already haven't checked out the links in my description to get started with investing, go ahead and do that and drop a like below, and don't forget to subscribe to the channel for more stocks and personal finance related videos coming very soon. On to the video. So before investing $1,000, the first thing I did and the first thing I would recommend for anyone to do is to set up an emergency fund. I can't stress enough how important this is because you want to make sure you have a bit of money to fall back on in the event that something happens in the market or you need a bit of cash to float some type of expense. But essentially 3 to 6 months worth of your expenses sitting as a, let's say, high interest savings account or some type of accessible account would be a great place to start before thinking of investing. Now, when looking at $1,000, I would start with about 25% or $250 directly invested into Wealthsimple Invest's robo-advisor platform. Now, on this platform, I would tend to go for a more aggressive growth strategy because long term, I can afford to spread out the risk evenly over a longer period of time. And what that portfolio typically builds is approximately 85% equity and 15% long-term bonds, gold, and cash reserves. Within that 85%, the robo-advisor is going to pick a handful of ETFs that track the S&P 500, the Toronto Stock Exchange, and other high-growth tech companies. This way, you're able to take advantage of the robo-advisor, which will manage up to $10,000 for free for the first year when you sign up using the link in my description. And you get the peace of mind in knowing that $250 is going to grow at a rate that will compete with the market. With the remaining 75%, or approximately $750, I've identified 3 major ETFs that further expose you to the market and broaden a bit of the perspective that you gain. Now, these are Vanguard's S&P 500 Index ETF, BMO's Canadian Dividend ETF, and iShares Core's S&P TSX ETF. With the 3 of these, they're a combination of gaining more exposure, getting a high dividend yield, and essentially a little bit of growth over the longer period of time because they're tracking the broader market. To start off with my first and most favorite one, ZDV.TO, otherwise known as BMO's Canadian Dividend ETF. It's currently trading at around $16.90 Canadian, and their dividend yield is approximately 4.79%. Now, what this means is on an annual basis, about 4.79% of the ticker's trading price will be paid back to shareholders as a dividend. Now, that dividend essentially means that the shareholders get a bit of a kickback every single month because this is a monthly dividend payout for essentially owning that stock. With ZDV, because it's providing you more of a broad exposure to all of the Canadian dividend-paying ETFs and stocks, you're diversifying more, you're attaining less risk than putting all your money into one stock, and you're still getting a pretty good dividend payout on a monthly basis. Now, my next favorite is XIC.TO, otherwise known as iShares Core S&P/TSX Capped Composite Index ETF. This one's currently trading at around $29.33, I believe, and its dividend yield is about 3.03%. So to say that whenever they pay out their dividends, approximately 3% on an annual basis will account from whatever the trading price is. And with this dividend, it's really easy because it's tracking the largest market cap companies on the TSX as classified by the S&P index. And this includes companies such as Shopify, TD Bank, RBC, CN Railway, Enbridge, and many other Canadian institutions. So it's a more diverse ETF because a lot of it makes up financial institutions such as banks. And then you have your aristocrats like Enbridge and CN Railway and many others like Shopify, which give you a bit of exposure to that tech side as well. And finally, one of my other favorites, VSP.TO, otherwise known as Vanguard's S&P 500 Index ETF. So a key thing to note here is there are US equivalents, but this one is Canadian dollar hedged. So it essentially tracks the largest market capitalization US stocks that are on the S&P 500. And among its holdings are other ETFs such as Vanguard's S&P 500 ETF, VOO, which is the US-based one. And this one gives you a bit more of an advantage being in Canada because you're not spending US dollars. It's in Canadian dollars. At about $65 per share, you're getting a quarterly 1.28% annualized dividend, which amounts to a pretty solid amount for literally just holding on to a $65 ETF. And with this one, you're getting a lot of exposures to large cap companies for just holding on to it. With investing 1,000 Canadian dollars, my main goal was to diversify my platform, build a bit of a dividend portfolio, and gain more exposure to the broader market. By using the Wealthsimple Invest platform and using the link in my description below, you get up to $10,000 managed for free for the first year. And the robot does all the work for you. You can go look at your portfolio. If there are any stocks that you really love there or any ETFs that you love there, you can go and purchase it on your own using Wealthsimple Trade. And it's pretty important that if you keep consistently contributing to your funds on a longer term, eventually those dividends will start to make enough money that they can either purchase a share on its own, or you can take that money and spend it however you'd like, because you're technically making money while you sleep at that point. $100,000 salary, here I come. Anyways, I hope you guys enjoyed today's video. If you did, please drop a huge thumbs up down below and let me know what you think and if there are any other ETFs that you would consider, and maybe I can feature them in future videos. But as always, thanks so much for your guys' support. Don't forget to subscribe, and I'll see you guys next time. See ya!